Most traders look for confirmation in structure, but the real shift in the market often happens before structure clearly breaks. If you understand how price transitions from control to execution, you can spot reversals earlier and enter with much better risk to reward. That is where the difference between change of character and change in state of delivery becomes critical. These two concepts explain not just where price breaks, but how momentum and control actually change behind the scenes. A change of character occurs when price begins to lose its previous structural control inside a broader swing. This process usually starts from a deeper pullback of the prior move, where price retraces 50% or even deeper of the swing. From this pullback, price develops a more complex movement, with both the expansion and the retracement containing several candles. This reflects a gradual transition phase, where control is weakening, but price delivery is still inefficient. The key role of the change of character is structure, not speed. It highlights that the prior directional bias is no longer dominant. A change in state of delivery focuses on how price is delivered rather than on structure itself. CISD typically appears after a liquidity sweep and is characterized by a sharp and efficient expansion, preceded by a short and shallow retracement, often around the 38.2% level. Both the expansion and the pullback usually involve very few candles. This reflects a sudden shift in momentum, where price moves with clear intent and efficiency. CISD signals that the market has transitioned from distribution or accumulation into active execution. In practical terms, CISD often appears before full structural confirmation. It provides an early indication that a reversal may be unfolding, especially when it occurs immediately after liquidity has been cleared from one side of the market. When combined with concepts such as liquidity sweeps and fair value gaps, CISD improves trade quality by aligning entries with momentum and institutional price delivery. Understanding the distinction between change of character and change in state of delivery allows you to read market transitions with greater precision. While change of character highlights structural weakening through slower and deeper movements, CISD confirms that price has shifted into an efficient and directional state. Using both concepts together helps refine entries, improve timing, and achieve better risk-to-reward conditions in high-quality trade setups. Hello and welcome back to another video here on the CommLucro channel. Today, we focus on how market reversals truly begin and how to read the transition between structure and momentum before the move becomes obvious. You will learn how to distinguish between change of character and change in state of delivery, so you are not misled by late confirmations or false signals. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now let's get started. So what exactly is the change in the state of delivery? The change in the state of delivery, CISD, is a reversal pattern in which the price's momentum and delivery shift direction suddenly. In this example, you can observe a clear bullish trend. These three candles represent the most recent bullish delivery, showing strong and efficient momentum, which has pushed price above a recent structural level. This can also be referred to as the most recent buy-side delivery. Some traders mark the candle open as the CISD reference. In our approach, CISD is marked at the pullback extreme, just like change of character and break of structure, using the highest point in a bearish scenario and the lowest point in a bullish scenario. At this stage, the structure still appears bullish, and after a short-term correction, price would normally be expected to continue pushing upward. However, if price suddenly shifts behavior and delivers a strong bearish move, closing below the demand area and invalidating the prior bullish delivery, this condition is known as a change in the state of delivery. So what does this signify in terms of price action? First, it suggests that the breakout may have occurred to engage liquidity above this market structure level, rather than to sustain continuation. The buy-side delivery triggers buy-side liquidity, which can then be followed by a bearish shift in delivery. A break below the demand level shows that buyers are no longer supporting price with the same efficiency, while sellers have begun to deliver price more aggressively. This change in delivery signals a potential transition toward a bearish phase. So how can we use this concept to enter a trade? At this point, the short-term market bias begins to shift to bearish, meaning we prioritize sell opportunities while still monitoring structural confirmation. After observing a break and close below the origin point of the prior buy-side delivery, we recognize that this area may now act as resistance. While this does not by itself confirm a full structural reversal, it provides an important area of interest. When price pulls back into this zone and bearish delivery continues, it can present a high-quality opportunity to enter a short trade. Since this zone previously acted as support and is now showing resistance behavior, the probability of rejection and continuation to the downside increases. Entering a short position from this area allows participation in the emerging bearish momentum with a favorable risk to reward profile. It is important to remain patient and wait for price to return to this area before entering the trade. This patience improves execution quality, reduces risk, and increases the likelihood of capturing a sustained downward move rather than reacting impulsively. The same concept applies to the bearish scenario. However, it is important to note that not every change in state of delivery observed on the chart will lead to a successful trade, especially if it occurs without clear context, liquidity interaction, or directional relevance. CISD on its own only describes a change in delivery, not a guaranteed reversal. To trade CISD effectively, it must align with other market factors and conditions. Through backtesting, we've observed that CISD patterns are most effective when they appear within a well-defined market context. To qualify a high-quality CISD and prepare for a strong trade opportunity, certain conditions should be present. Let us now discuss the key factors that enhance the reliability of a CISD pattern. Rule number 1. Reaction at a higher time frame key level. As discussed earlier, CISD represents a shift in price delivery, and it becomes significantly more relevant when it occurs after price interacts with a higher time frame key zone. Key levels on higher time frames, such as the 4-hour, daily, or weekly, carry greater influence over price behavior. When price reaches these zones and a CISD forms, it suggests that delivery is shifting at an important area, increasing the probability of a meaningful move. Without higher time frame context, a CISD may still appear, but it's more likely to represent a short-lived fluctuation rather than a sustained transition. Rule number 2. Sweeping a liquidity pool. A high-quality CISD setup often occurs after the market sweeps liquidity from one side. Liquidity pools form around obvious equal highs and lows where traders place stop losses. When price sweeps these levels, it engages resting liquidity and creates the conditions for a potential shift in delivery. Once this liquidity is taken, price is more likely to transition into efficient movement in the opposite direction, making it an ideal environment for a CISD to appear. This does not confirm a reversal by itself, but it strongly increases the relevance of a CISD by showing that liquidity has been cleared and delivery conditions have changed. Rule number 3. Volume and confirmation. For a valid CISD setup, it is important to observe an increase in activity during the shift in price delivery. Higher participation reinforces the efficiency of the move and supports the change in momentum. Entering a trade based on CISD without this confirmation can be risky, as it may reflect a weak or short-lived change in delivery. This increase in activity is often visible through the formation of fair value gaps. Fair value gaps appear when price moves aggressively, creating imbalances that reflect strong directional intent. When a CISD forms alongside a fair value gap, it suggests that large participants are actively delivering price, adding credibility to the setup. A retracement into the fair value gap can offer a high probability area of interest, as price often revisits these imbalances before continuing in the direction of the new delivery. Combining CISD with fair value gaps improves timing and reduces execution risk. Rule number 4, waiting for the pullback to the reference level. After price breaks below or above the origin point of the prior delivery, it is important to wait for a retracement. This pullback allows traders to evaluate whether price accepts the new state of delivery. Rather than viewing this strictly as a structural flip from support to resistance or resistance to support, the focus should be on how price behaves when it revisits this area. Acceptance or rejection during the pullback helps confirm whether the new delivery is likely to continue. Entering on the pullback improves your risk-to-reward ratio and provides clearer information about whether the new state of delivery is being accepted. By following these rules, ensuring the CISD occurs at a key level, observing participation and delivery confirmation, and waiting for a retracement, you increase the chances of identifying high-quality trade setups with strong potential while controlling risk. Now that we've explained what the CISD pattern represents and the conditions required to apply it effectively on the chart, let us look at some real chart examples to see how these concepts work in practice. Here we have the euro-dollar on a 15-minute chart. We can see a bearish market structure where price has recently broken below a key level that had acted as support multiple times. If we analyze the latest impulsive movement that caused this break, we can observe strong bearish delivery, highlighted by the creation of a fair value gap. This reflects efficient selling pressure, pushing price lower. From a price action perspective, a pullback into the former support area allows us to evaluate whether bearish delivery continues rather than assuming continuation automatically. However, what followed was a strong bullish move with fair value gaps that pushed price back above the resistance area. This sudden change in efficiency and momentum signals a change in state of delivery and a potential transition. Additionally, this move appears to have engaged liquidity resting below the equal lows before delivery shifted. Based on this new information, we reassess market conditions. Some traders choose to mark the opening of the candle that initiated the bearish order flow as a reference level. However, in our approach, we mark the CISD in the same way we mark change of character and break of structure, using the extreme of the pullback. In a bearish scenario, this is the highest point of the retracement, and in a bullish scenario, it is the lowest point of the retracement. When price returns to this area, we observe how delivery behaves and look for confirmation before considering a long position. Before entering, it is essential to zoom out to a higher time frame, such as the 4-hour chart, to gain broader context. Higher time frame analysis helps determine whether the shift in delivery aligns with significant levels or larger directional conditions. On the 4-hour chart, price has interacted with a key level, and reactions at these areas can influence lower time frame behavior. This higher time frame context supports the bullish delivery observed on the 15-minute chart and helps to find realistic targets ahead of current price. Returning to the 15-minute chart, we can structure the trade according to our plan. A buy limit can be placed slightly above the origin of the new delivery, with predefined risk parameters, such as a 2-to-1 risk-to-reward ratio. Stop loss placement is defined to protect against adverse movement. This demonstrates how CISD can be combined with multi-time frame context and price action principles to build a high-quality trade setup. Regardless of how strong a setup appears, disciplined risk management remains essential, as market conditions can always change unexpectedly. This approach helps protect capital while allowing participation when price delivery aligns with the anticipated direction. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the CHoCH trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the CHoCH channel is simple. We help traders build clarity, confidence, and structure. so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and CHoCH. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.